Hello, today on the final bar, we're talking with Patrick Ceresna from Big Picture Trading. We'll talk about this overall market environment. We've talked a lot about the rally off of the lows, sort of this consolidation, congestion, digestion phase over the last week and a half, 2 weeks. Now today, we're getting that rollover. We're getting a lot of distribution going into the last hour of trading, closing at the lows of the day just below 40.20. Is this the beginning of that next big leg downwards? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com. It's Thursday, June 9th, talking about the market rolling down to the downside after a bit of distribution yesterday, but still kind of hanging in that range today, finally rolling below the range that we've established over the last week and a half. We talked in recent episodes about this digestion phase, right? Sort of the big meal coming off the lows, and we're sort of digesting it. And the question is, what's next? Now we're getting an indication that this is resolving to the downside. So potentially we're sort of renewing this this downward push that we've been in. In our mailbag, we actually had a comment, someone asking what was worse, the Seattle weather or the charts. That's cold at number one as a Pacific Northwesterner, but very fair, and it's absolutely right. They're reflecting one another. We've got rain going just as we get the show started. You know, at the end of the day, the market is all about different timeframes. It's all about connecting the short term and the medium term and the long term. That's why my market trend model has those three phases. Let's talk about each one of those on today's show and sort of where we're at in each of the three different timeframes. Now, we have great guests on the show. I'm excited for Patrick Ceresna to be joining us here in a few moments. Next week on Tuesday, the 14th, it's Ms. Schneider from Market Gauge coming to us from New Mexico. On Wednesday, the 15th, fund manager Dana Lyons from J Lyons Fund Management and editor of the Lions Share Report. On Thursday, the 16th, Cliff Droke. Cliff focuses on gold and materials. It's a very interesting space, given the fact that the market really has done a lot of things with gold, really not a huge factor with the strength in the dollar. We'll see what's going on there. And going up on June 20th, on Monday, we'll be celebrating the Juneteenth holiday, taking a break from the show. Also wanted to let you know our upcoming webinar with Market Misbehavior. Go to marketmisbehavior.com/market bottom. Next Tuesday, the 14th, 1 o'clock Eastern, I'll be doing my latest free webinar talking about market bottoming conditions. What's the checklist we should be following to anticipate when a bottoming is nearing, when it is in process, and confirming the bottom has actually occurred. We can look at some of the historical observations, come up with a bit of a checklist together, and we will do that live. Go to marketmisbehavior.com/market bottom to sign up for that free event. Let's continue on with our market recap. As I mentioned in the introduction, market rolling over a bit to the downside. Let's see what damage was done today and how that fits into the overall market structure. S&P down 2.4% here going into the close, just below 40.20, closing around 40.18. The NASDAQ composite pushing down a little further, almost 3% down for that index. Mid caps and small caps, both down about 2%, not quite as much as the S&P, but quite a bit of a pullback after the consolidation we've seen in recent weeks. The VIX actually moving higher. The VIX has actually been coming off, going below 25, now pushing back above there to 26. We'll look at sentiment indicators a little later in today's show, including a chart of the VIX. So we'll get into a little more detail there. Interest rates mixed, actually. So long bond yields actually came off a bit to 3.17. 10-year yields pushing a bit higher, 3.04 around the close. The TLT, which is our proxy for bond prices, up just about 1/3%. The dollar index pushing higher, 0.7%. Talk about materials and right how gold has not really participated in the upswing. Gold tends to be a good inflation hedge. It tends to be tied to real rates, looking at interest rates versus inflation. And the problem is the dollar, or not the problem, but the reality is the dollar has been so strong that gold denominated in US dollars had just not been able to materialize a lot of gains. Looking at The GLD, you can see down about 1/3%, silver down almost 2%, crude oil prices down as well, although some other commodities, some of the soft commodities were up just a bit. Finally, cryptocurrencies, actually a decidedly quiet day, even though equities down quite a bit. Cryptocurrencies had bounced around a bit. So Ether about where it was 24 hours ago. Same with Bitcoin down about 0.4%, bouncing yet again off the 30,000 level. And I've mentioned this many, many times. Big round numbers for cryptocurrencies tend to matter. 30,000 has been right about where we've been chopping around for a number of weeks now. And I think that's still a key level to pay attention to. You know, I mentioned the S&P 500, sort of the three different timeframes. Tomorrow on the show, we'll do our weekly wrap where we'll always refer to our market trend model. I just want to spend a few moments on this because I think it illustrates where we're at right now with these different timeframes. I think of the market in three timeframes. Long term is sort of, over a year, right? A year, 2 years, even beyond that. Medium term for me is a couple months, right? 1 to 3 months on average. And then the short-term time frame is a couple days to a couple weeks, sort of that short-term one. There are shorter-term time frames, and if you're more of a swing trader, more of a day trader, then you obviously have intraday time frames that you're thinking of. That's a little more granular than I tend to pay attention to. I'm looking more for the big picture, and I'm thinking of it in terms of those three time frames. Now, if you look at what my market trend model has been saying, long-term bearish since early May, medium-term bearish really for most of 2022. It turned positive for a couple weeks there in late March, early April, but then again, being down, going below the zero line. So overall, for the most part, negative since mid-January of this year. Short-term model bouncing around a lot more often, which is kind of what happens, had been bullish a couple weeks ago, and then just last Friday turning bearish yet again. Actually, I think this might be just this week. I think last week was narrowly positive, if I remember right. And, with the deterioration we've seen so far this week, when I update the model on Friday, would certainly turn bearish again if we would close the week around current levels. So that configuration over the last couple of weeks of long-term bearish, medium-term bearish, short-term bullish is exactly how this market has felt to me. I still would argue that the overall trend most likely downwards. The medium-term trend, sort of that main time frame I'm trying to focus on, a couple of months down the road, has overall still been has been essentially negative. The short term is what's been positive. You need to see more improvement, more accumulation, more signs of capital injection, whatever you want to do to describe an influx of buyers and how that would push prices not just up off the lows, but a higher low, right? Sort of materializing more of a significant gain. That's what I think we've not quite seen yet. And it's not just on the S&P itself. And we're going to talk with my guest today, Patrick Ceresna, about the daily S&P charts. We can come back to that one in a little while. But I think that, what I've not seen enough is enough of an improvement that tells you it is a rotation, right? What I call a change of character. I would argue the character of this chart of the S&P is fairly consistent. It's been sort of negative with some short-term optimism that's been popping in there. Let's finish off our market recap looking at sector movements. So the two consumer sectors are actually at the top of the list today. Staples up down 1.5%. Sorry. So the best performing sector still down 150 basis points. Tells you a little bit about the character of the market today. Consumer discretionary second from the top, down 1.8%. Industrials number 3. At the bottom, some of the FANG sectors like communication services, technology, both down 2.7 to 3.1%. Financials third from the bottom. So very much sort of a rotation to risk off. I was looking at some of the questions we've received, and one of the questions we hopefully will get to in tomorrow's mailbag, we'll be talking about that growth versus value. And the short answer when you think about growth versus value is in a true down phase, right? In a bear market phase, usually pretty much everything rolls over, right? And what's been one of the weird parts of this market in 2022 is energy has been so strong. I will tell you that is highly unusual. You have one sector up 40, 50, 60% while everything else is down. It's kind of weird. This has been an interesting market for sure. And that's why I always tell people, having done this for 22 years now, the market never really repeats itself. It often rhymes. This is a unique feature of 2022 that has not happened as often, which is one sector is such a clear outlier. And it's just such a unique scenario with energy doing so well. But in a true bear market phase, we look at an average bear market, it's kind of everything struggling. Things like utilities or real estate will outperform, but they're probably sort of flat to down on an absolute basis. That is sort of that big risk off move that we've not quite seen enough of just yet. Finally, to finish off, just really quickly, wanted to talk about some of the stocks that were down. We highlighted Royal Caribbean as one of our 3 and 3 charts yesterday on the show. Worth noting that 3 of the worst performing names today in the S&P are those cruise lines: Carnival, Norwegian, Royal Caribbean, all sort of rotating and testing the lows. RCL at 50. And this is the sign of a market that breaks down. If you're looking for what's the trigger that the market's going to do the next leg lower, it's things like RCL don't just retrace their previous gains, but they undercut the previous lows. We sort of undercut on a closing basis, just barely. But that's where things can bounce if you get buyers coming in and buying on short-term weakness. Charts like this start to break down, become oversold again. All of a sudden, this market starts to look a lot less constructive than it was a little bit ago. We need to continue on and go to a commercial break. We'll be back with a few moments with our guest, Patrick Ceresna. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the markets, try as much as we can to connect the short-term movements of one trading day with the bigger picture and how it affects the overall trends. We have a great guest today, Patrick Ceresna, who we'll bring on in a few moments. Before we do so, a couple quick announcements. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show on Friday of this week. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have expert guests with some fantastic expertise about this market environment, helping you navigate things in uncertain times. Larry Williams just did a market update last week, which was really well done. So much great content for free at all times at StockChartsTV.com. We're on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Patrick Ceresna. Patrick's the founder of Big Picture Trading, also the host of Macro Voices and Market Huddle podcast. Patrick, it's good to see you. Welcome back to the show.
Dave, thank you for having me back on the show. This is great to be on.
Yeah, it's good to see you. We were talking about the S&P 500 before the break. You shared your chart, a candle chart of the S&P going back a little ways. Help us make sense of this market. What are you seeing right now?
Well, listen, your analysis of the S&P 500 was bang on, and so I feel like I'm going to repeat a couple of the same things that you were talking about. But I want to, let's say, have a conversation to highlight some of the key things to observe about the way the market has behaved. Now, if those are technicians amongst our listeners that understand the way bear market rallies occur and or market reversals occur, they tend to actually be quite violent. Often you'll see the rallies off of those levels have real velocity. And what is shocking to me is how big of a dud of a bounce that this has actually been. Even if you go back to the March rally, the velocity there was like a 500-point rally that was a legitimate squeeze. Shorts were being thrown out. Everyone was asking whether it was a new bull leg. And this time around, while we're looking at the S&P not even making a 50% retracement, but the rally in the NASDAQ was awful. The tech names aren't even bouncing. And the bear market that's been in all of those unprofitable tech. We'll pick on ARK Investment and Kathy, and just how very weak that we have seen the bounce be in off of a very oversold condition. And this highlights the fact that we have a bigger macro backdrop, which is a tightening market that is going risk off. and a lot, and whether or not we're talking the fangs, like look at Facebook's about to make a fresh low, Netflix is bouncing horribly, even after a stock split on Amazon, it's already giving back the initial positive reactions. Those core stocks that need to be leadership in order for there to be a bigger market reversal are just not coming back to life. And a new bull market can't just happen on the back of energy alone. And so the backdrop in the current market environment remains very suspect. And the one thing, though, that I was highlighting in our conversation prior, while we had a really big down day, I'm still not so sure that this is the beginning of already the next downside impulse move on the market. Often, especially going into the summer and lower volumes, there's a lot of chop. And I would not be shocked if the 4,000 level was to usher in a bounce. Like tomorrow we have CPI, and so tomorrow when the CPI numbers are coming out, maybe everyone is too worried about them, and the market has a sentiment kind of little twist where the market bounces in the post CPI number. And the point is that it doesn't make me bullish if we got a bounce. It's simply I think that there's a very legitimate chance that the month of June is a grind. It's gonna market's gonna fake out down, fake out to the upside, and we might find ourselves at the end of June at the same price we're trading at today. And while the primary trend remains a bear market and down, and so long as that stays in place, we may have a very challenging period later in the summer. But I'm not so sure that hammering the short sells this afternoon is the right trade. And so that's sort of my underpinning thesis. And overall, volatility remains heightened. Usually, from the options hedging side of the story, when you have collapses in volatility as the VIX heads down to the 20 handle or lower, that means that dealer hedging massively reduced. They contribute to the buying. They create that Vanna slingshot to the upside of the market that contributes to that feedback loop of buying. No sign of it. Just no sign of any of that. The risk premium is still being commanded on option hedging. And this continues to be a period where being overweight cash and being defensive, being hedged is the name of the game. And maybe at some point the bear market will end this year, but I don't see any sign of it right now.
It's such a great thing. You hit on so many great things, Pat. I wish we had an hour to go through each one of those points that you went through. We only have about 30 seconds left. I'd love to just ask you, assuming this bear market phase does continue, let's assume we chop around and go lower. You mentioned getting defensive. Give us an idea of where you'll be looking. Is it something like a utilities, like a pure defensive play? Is it an inverse ETF, so you're trying to benefit from downside? Like where would you point people if they're struggling to find ideas here?
The only thing bulling are select parts of the resource markets, including particularly energy. In the consumer staples and defensive names is defensiveness, which is that on a relative basis, they are going to be a place to hide, but that doesn't mean you'll make money in that space. You'll carry a dividend and have some defensiveness. I think, though, that the place to generally be massively underweight is unprofitable tech. And even though it's already, 70+% off of its highs, in bear markets, they still can get halved again, and there's still room for further weakness. So, being defensively positioned isn't guarantee you make money, but really, there's that saying, you got to tell me who said it, but it was who loses the least in a bear market is the winner, and you want to basically batten down the hatches. If you can survive the storm, there's going to be plenty of amazing buying opportunities on the other side, but you got to survive this kind of choppy period and be defensive. That's what I got.
I love it, Patrick. And I was told that prices go down for a reason. So some of those emerging growth names are down for probably a legitimate reason. No reason why they can't stop here. Listen, it's great to see you, Patrick. Thanks again for joining us on the show. Stay safe, travel safely, and we'll talk to you again soon.
Thanks, Dave. And thanks for having me on the show. Cheers.
That's Patrick Ceresna. Patrick's the founder of Big Picture Trading. He hosts a couple podcasts, which I've been a guest on, which I really would encourage you to check out. Market Huddle and also Macro Voices, you can see, is just a great way of sort of laying out the overall conditions. And, we're pretty much on the same page with a lot of that thesis. I think we were talking before we went live on the show that the market can go three directions. It can go higher, it can go lower, and then can go that really painful third direction, which is sideways. And arguably, we could be range bound for a little while here. How frustrating would that be? Great take there from Patrick Ceresna, Big Picture Trading. Let's continue today's show here on the final bar. We'll go to our next segment, Getting Sentimental. What we like to do with some regularity is go to some of the market sentiment indicators, see what they're telling us about the overall market conditions. And, I have talked about the three parts of a macro analysis, in my opinion. Start with price, then you go to breadth, then you go to sentiment. What does the price tell you about the overall supply and demand picture? What does breadth tell you about the individual stocks that make these broader indexes that we track? And then finally, sentiment. We can look at positioning data, and we can look at volatility, and we can look at survey data. That's what I sort of generally group into a bucket called sentiment indicators. Let's look at a couple of these and see where they're at. I appreciated Patrick mentioned just a few minutes ago about the VIX, just volatility remaining fairly elevated, pulled down to 20 here. And that's the chart we're looking at going back for a couple of years. The VIX for 2022 has basically spent the entire year above the 20 level. It's bounced back down to it a couple times in early February, again in late March, mid-April. Every one of those times, we've seen it bounce higher, we've seen the market rally and rotate lower. Now, what's interesting right now is if this would be a top and we roll down lower, which again, I'm not convinced is the case yet. We could certainly chop around and again, tomorrow could finish the week completely differently than what we're seeing with today's distribution going into the close. But if this will be the bottom, the VIX is actually kind of higher than it has been at market tops over the last 6 months. The market's usually bottomed out when the VIX is up around the 30 level, even 35. Not when, excuse me, I'm looking at the wrong thing. It's topped out. The market is topped out when the VIX has gone below 20, right? And that's what we saw in the end of last year. That's what we saw in February. That's what we saw in March. Market rallying, the VIX coming down, volatility decreases to around 20, and we rotate higher. The market would peak out here around 4,200 with the VIX at 25. That could be an indication that the volatility regime is continuing to inflate. Maybe the new range is 25 on the lower end and 35 on the upper end, right? Maybe we're just continuing to escalate this volatility regime and continuing this uptrend in the VIX over time. Having said that, it's always interesting to look at where we're at within this range. We're currently mid-range from where we've been since last November, which I would argue is essentially the market top there. So neutral, I would argue right now from the VIX. If you're looking at the survey data too that we tend to pay attention to, the one is the AAII survey. This is looking at individual investors every week. Are you bullish, bearish, or neutral on stocks? And you can see that last week we had quite a reversal, right? All of a sudden it was up to almost levels, about a 5% spread. Bears still outnumbering bulls, but not by much. This week, right back to where we spent most of the last 6 months, which is bears far outnumbering bulls. In this latest survey just completed earlier today, reported earlier today on Thursday, 47% of respondents were bearish, 21% are bullish. So over a 2-to-1 ratio favoring bears over bulls. That's a 26% spread, not the extreme level that we've seen at times of severe bearishness, but pretty healthy, right? And this is a similar level to where we've spent most of 2022. So sort of average investors are sort of confirming this negative trend that we've seen so far in stocks. The name exposure index popped higher this week, up to about 50%. So overall, a little lower than average, right? The average allocation using this exposure index is around 70% or so. And again, this is serving a bunch of money managers. What's your allocation to equities? And so coming up from 20% up to 50% over the last 3 weeks, certainly encouraging, showing the money managers are starting to participate in this rally, but nowhere near sort of a bullish reading telling you that that money managers are getting all in. This is more of a still an underweight on the equity space. The Ridex flows actually popped back down, so increased on this chart. If you look, the histogram getting closer to the zero level shows you that People are rotating over the last week from more of an offensive positioning to a little more from a defensive positioning back to a little more of an offensive positioning. But again, nowhere near the bullishness that you saw in the fourth quarter of 2021. Overall, investors on this survey still bearishly positioned, but not as bearish as we've been at major market bottoms. That's one of the charts that tells me to not be surprised with further market downside and further rotation to more defensive parts of the ledger. Finally, put call ratios. When you look at the last couple of years on the far left of the chart, you can see what happened to put call ratios in March of 2020. Basically, February to March, you saw an explosion in the put call ratios going very, very high. The gray line is the raw data. This is a daily report that we get from the CBOE. So it's pretty noisy. I like to look at a 5-day smoothing of that, which is the pink line here. And the 5-day moving average currently right around 1. So it's essentially even between puts and calls. And this is using total. So it's using equity and index options all together. It basically says where options investors are positioned on any given day at the end of the trading day. So right now, if you look, still fairly elevated to where we've spent most of 2020, most of 2021. We're still, 2022 has been obviously a higher general range of the put call ratio, but kind of right in the middle of where we've spent 2022. So I would argue with this, some of the other indications like the VIX, we're sort of mid-range, right? It's not overly bullish, not overly bearish, sort of in the middle. That is our segment, Getting Sentimental. Again, I like to check in on those about once a week for sure and check out where they're at. Make sure you have a sense of where investors are positioned and what they're thinking. We have some of this indication that investors still remaining broadly bearish when you look at some of the survey data. We need to wrap today's show, though, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes. And here we go. Chart number 1 is the high yield OAS. I like to bring up this chart just to think about the VIX, think about credit spreads, and think about the S&P 500. From the top, we have the high yield OAS. This is basically credit spreads, and we're using the high yield OAS. And if you don't know what that is, we don't have time to get too much into it, but this is basically the premium that investors in junk bonds, high yielding bonds, maybe risky bonds, what sort of spread are they looking above a conservative, like a risk-free interest rate, like a treasury bond? What sort of additional premium are they requiring to invest in high yield debt? You can see that spreads have been increasing, and I can tell by this because this is plotted inversely and the trend overall is down. This rally here, or this decline in spreads, aligns with the rally that you've seen in stocks. You can see a similar drop in the VIX, again, plotted inversely, because you can see this overall pattern, widening spreads, increasing volatility, decrease in the S&P 500. We've bounced on all 3 of these, and I'm very curious to see if we start to roll over the high yield spread rolling over, the VIX still remaining fairly low. Do we see a follow through to the downside? This might be an interesting chart to watch to see if we do get a follow through on stocks to the downside. Chart number 2 is the New York Composite Index, $NYA on our StockCharts platform. If you're looking for a chart to confirm your bearishness, and I hate the way that I just said that because I don't want you to do confirmation bias. That is a no-no. However, if you're looking at the evidence, I would conclude that this is more of a bearish structure. And here's why. We had the rally in 2020, 2021. We then have a fairly consistent support level around 16,000. We broke below there in April into early May. We now rotated right back up to there. We tested that from below. Also the 50-day moving average today, rotating back below there. So we have the New York Composite Index stalling out at resistance. We have momentum, the RSI unable to get above 60. That is a bear market phase until proven otherwise. Finally, Alphabet. My guest today, Patrick Ceresna, what a great take on a number of different areas. He touched on so many things, but one of the things he talked about was the lack of participation in the FANG stocks. I was looking through a series of charts on the FANG names. It struck me on this candle chart how many long upper shadows we have. Look at the last 7 or 8 trading days. Almost all of them have a long upper shadow, or over half of them. That is a sign of a market that is exhausting to the upside, right? You're pushing higher, but you're opening, you're trading higher, you're closing back at the lows of the day. That overall is showing you a pattern of short-term distribution. And again, while this is a short-term indication, a market rallying and then getting these long upper shadows telling you that there's an evaporation of buyers, there's no one left to push the price higher, that type of performance usually resolves to the downside. So I'm not surprised to see Alphabet and the other FANG stocks all rotating lower today. Folks, that is our show for today. I want to thank you for joining us every weekday after the close For the final bar, special thank you to Patrick Ceresna joining us from Big Picture Trading based in Toronto, giving us his take on the overall market environment. All of our previous episodes and interviews can be found for free at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.